Hello, everyone. I'm Steve Hovland, founder of Delegate CFO, virtual CFO website. Today's webinar is designed to demystify what happens after you hire a virtual CFO, in particular, the first 90 days of that process. And so I hope you find this very informative, and hopefully it makes it easier for you to understand what happens after you go ahead and hire that respective firm. So let's go ahead and get started. Um, First item is to understand once you've pulled the trigger and you have your virtual CFO firm, you want to really know what's going to happen now. And again, this webinar is mainly geared towards our firm, but other firms may be a little different. But we want to go over what's going to be the process now that you've hired us as your firm. So what can you expect? And one of the big things that we say is we want to set the expectations and we want to drive results. They go hand in hand. So that's very important on this. So first off, a little bit about the company. Delegate CFO, I founded that back in 2019. I used to be an audit partner in a 100-person CPA firm. And during my time as an audit partner, I saw a lot of small and medium businesses that really needed somebody on staff or to help them with cash flow, budgeting, forecasts, etc. But they really didn't need to have somebody sitting there full time. And at that point in time, a full-time CFO salary averaged about 150,000 a year. So they really didn't need somebody sitting there 40 hours a week, going through their respective process. They really needed somebody to help them along the way with, again, forecasting cash flow, but they only really needed it part-time. And so, being in the public accounting world, I've seen a lot of different processes, procedures, industries. And so with that, I decided it was best to design and develop a firm that really services those small and medium companies that they really need the help, but they don't need somebody sitting there full time. I am also a CPA, a certified public accountant, as well as a certified forensic accountant. So in my other role, I do forensic investigations, mainly looking for fraud on both civil and criminal cases. So I do have that other aspect, and I bring that to the respective company of Delegate CFO. So all our respective companies that we bring on, I will do a thorough internal control review of their processes and procedures, in addition to obviously doing the standard CFO role. This webinar, again, the agenda is we want to, again, demystify how the process is and what we as a firm do when you come on. We have set criteria and set metrics that we go through so that once we get to the 90 days, we are off and running and we're helping you make your business more profitable. And again, like I said, we hope that this is going to be very informative and again, takes out some of those questions you may have. So why does the first 90 days matter? Well, this is ultimately the foundation for a successful partnership. And this really ensures that we're aligning all our goals and we're doing quick wins because in this time frame, this is when we're able to determine what is the best aspect for your respective company. So that's why this particular time frame is so critical to again build the foundation and launch the company forward as we go through. Now, common questions we normally get is, what does onboarding look like? How soon will I see results? How much input is expected from me being you, the client, and then what's the communication process? Again, these are the very standard questions that we get. Of course, we get more questions, but these are kind of the common ones. So we're going to go through and answer those as we go through each of these respective slides. Now, the process that we go through, and we have kind of a set criteria, is on our 90-day timeline, we break it down into 4 main sections. First one, obviously, is the kickoff and intro. We introduce ourselves, we do the kickoff. Weeks 1 through 2, we do discovery process. Week 3 through 6, an assessment. And then 7 through 12, we implement and do early impact on the respective recommendations. So let's go into weeks 1 and 2. So obviously, we do the standard kickoff. We meet with leadership and key stakeholders. Usually we'll meet with the ownership first because they're going to be the ones that are really driving a lot of what processes, procedures, and services that we're going to perform. And so we'll meet with them. And the big item, and this is really the biggest thing throughout this whole process, is that second bullet point in the slide you're seeing is understanding the business's goals. Obviously, we want to know the pain points and current processes, but your goal for your business is the biggest driver on everything that we will build, either from the forecast to the KPIs to the cash flow. Whatever your respective business goal is going to be the biggest key to this whole process. And one business's goal could be completely different from another business's goal. So case in point, you could be a manufacturing company and you just want to make sure that you're making net income by the end of every year. Whereas another goal could be, you're a mature company and you're looking to sell in 3 years. And so you want to build up your financials. Each company, even if they're in the same industry, is going to have slightly different goals. Now, obviously, one of the main goals is obviously to make net income, but outside of that, there are specific goals that we want to understand as a CFO firm, and we want to be able to use that to go ahead and develop everything, both with communications and with process and procedures. Obviously, in the kickoff phase, discovery phase, we're going to be collecting a bunch of information, existing financial system or data systems, and we're going to be setting expectations for communications and deliverables. So when we first bring on a client, we're going to have a fairly lengthy list of items we're going to need, such as tax returns, chart of accounts, org charts, you name it. There's a lot of information that we need to be able to access and look at as we're building everything in the background. And because that list is so big, sometimes what we do is we will break that list down into manageable chunks. So let's say we have a list of 20 items and it's September 1st. We may say, okay, these first 5 items, we don't need these until September 10th. The next 5 items may not be until September 15th. And so we'll put specific dates on items that we need. And obviously, the most critical items are going to be the items we need first. But in there, we're going to build it out so it's manageable. And so we will be communicating with you on that process of saying, here's the list of information we need. Here's what we have received. This is what's coming up, and we'll send notifications on that as well. Now, a lot of our clients sometimes will just knock out, the whole list within a week, which is great. But again, we want to make it so it's not too onerous when you're going through and getting that information or the request from us. Now, weeks 3 through 6, this is where we start doing the deep dive assessment. We're going to be analyzing your financials, your processes, and your systems. Again, we're going to be looking at a lot of your historical data. We're going to also go look at, identify gaps, risks, and opportunities. Now, the risks are going to be both from a cash flow standpoint and from an internal control standpoint. And again, we are probably one of, if not the only firm that has a forensic accountant on staff that we are going to go through and we're going to analyze your internal controls. We're going to make sure there's no weaknesses in there because you can build the most pristine budget, forecast, cash flow, runway, all that can be just absolutely perfect. But if somebody's stealing from you, that's not going to matter. And so that's why we make it key that we want to make sure that your internal controls are as airtight as possible. Now, we understand sometimes, we have to mitigate certain controls because of staffing issues or shortages, but we want to make sure that they're as tight as possible. Then, we're going to benchmark your performance against your industry standards. And again, we do this because, we're looking at your data, but we want to know what are your competitors doing? Is your gross margin, say 20%, but your competitor's gross margin is 30%? We're going to start benchmarking that data because then that starts giving us ideas as to where are there opportunities, where are there inefficiencies that can be exploited and also increased or made better within the company. And then we're going to start building your dashboards and obviously the reporting tools. Now on the dashboards, the key part to this, and this goes back to that very first slide where we talked about the goals, we're going to build your key performance indicators, your KPIs. And those KPIs have got to be relevant to your goal. Now, we don't believe in putting a KPI in there that really isn't relevant to what your goal is. So if your goal is to get to, say, 1.2 million in revenue by the end of the year, we know we have to average 100,000 in revenue per month. Then we may be breaking it down to, okay, this is how many sales per day you need to have, or how many units you need to have. And so we're going to be developing those KPIs that allow you to actually manage your company towards that goal, not give you a KPI such as, the current ratio, which is current assets over current liabilities. That gives you a number, and we call those warm and fuzzies because they look good, but they don't really help you manage your company. So we're going to be developing those dashboards that actually help you manage your company. Sometimes you'll hear it classified as a financial lever, because there's different levers that you can use within your company to get to that ultimate goal. And then, of course, obviously, we're going to be putting in early recommendations and communicating with those. If we start seeing items, say there's a lot of accounts receivable that probably could be collected. There was maybe a sale that didn't get recorded that should be recorded, and now you've got a receivable to collect. Again, we're going to go through and get those early wins for you as we go and analyze your information. Now, obviously, we're going to put these quick wins in recommendations into actions. If it is a collection item, can we adjust how you collect the respective receivables? Is it possible you get a retainer instead of doing collections type situation? So whatever that recommendation is, we're going to go through and see what we can put in place. We're going to address your highest, priority risk. This is obviously internal controls, but we're also going to look at, revenue. If you're making a widget, are you utilizing the capacity correctly? Can we adjust that capacity flow? Is it we need to order more inventory so that we're coming up on the holiday season, and we will need to make sure you don't run out, because then those are lost sales. Whatever those respective items are, we're going to start highlighting those. And again, we're going to implement and improve the reporting both on your financial statements and also on your key performance indicators. So from a financial statement standpoint, we're going to make sure that they're consistent. And when you look at just your core financial statements, you're able to easily analyze and understand why the structure is set up the way it is and how that flows through all of the respective statements, from the balance sheet to the income statement to the statement of cash flows. And again, we're going to do regular leadership meetings. And one of the benefits of having us on as your virtual CFO is, yes, we're very focused on accounting and processes, cash flow, etc. But a lot of times our clients will actually use us as sounding boards for items that that's not really our industry, such as SEO. They may be working on their website and trying to get search engine to increase. And sometimes they'll use us as a sounding board. So it's not uncommon for one of our meetings to digress into an area that's really not our forte. But as a sounding board, as a business leader, they like to bounce ideas off us. So we're also involved in that as well. And of course, we will adjust any action plan as needed. Now, typical early deliverables. We are going to improve the clarity on your cash flow. As obviously one of the things what we'll go through is we're going to analyze your cash flow, make sure that if you have a runway, you're not getting too close to the runway. And runway being you run out of cash. We're going to streamline your financial process so that you're getting your financials timely. It doesn't do you as a business leader any good to get your financials for, say, July in October. That doesn't do you any good because we've already had other months go through. So we want to make sure we streamline that process and you get the information timely. Obviously, with our dashboards and your metrics, we're going to allow those, again, to be able to adjust on the fly, how your company's doing. If revenue was supposed to be, say, $50,000 in July, and you're only at, say, $10,000 and it's July 15th, okay, how do we make sure that we move forward to be able to get, to that 50,000 mark, another 40,000 within the next 15 days? Again, we're going to be building that into your respective dashboards. We're also going to be analyzing, cost savings and revenue opportunities. So case in point, one of our clients that we had was a manufacturing client, and their product could be used on aircraft. It was, engineered to be able to be used on aircraft. However, they didn't have the respective designation stamp that you need to have to be able to sell on that. And once we identified that, they were able to actually go through that process, and now they're able to sell the aircraft. And so they just increased the revenue on a product they're already making anyways. Now they had to make, several little engineering adjustments to the product, but for the most part, that was another revenue opportunity they had. And then from here, we're now going to start doing a roadmap for the next steps. How do we grow your company? How do we increase your return on investment? What does year 2, 3 start to look like? Once we've built that foundation on the first 90 days, then we can start doing a launch and go forward onto ultimately where you want your company to be in the future. Now, your role in this. Now, we need the information timely. That is a key. We can only work with the information that we've obtained. And so that's what we tell our clients is we'll usually give you kind of deadlines. Again, back to that first slide where we talked about the list, we break down the respective dates on there. And so that gives you an idea as a client, okay, I need to get this information over to them or make it available to them by this time. And so we need to have timely information, not only information, but also communication. So open and honest communication. If you're indicating that, yes, we're going to hit 50,000 in July, we built the budget that way, but then it's looking like that's not going to happen. The sooner you communicate with us, the sooner we can go ahead and make the adjustments so that, yeah, we might not hit that in July, but how can we make it up in August, September, October? Also, this allows us to react if something significant happens, such as your supplier for a main part of your raw materials is now in trouble, and you're trying to figure out where to get your information, your respective raw materials. And so that's one of the things is when you know information like that, go ahead and communicate that to us so we can react on our side to be able to help you make your decisions that really are going to impact the future. And then, of course, setting clear goals and expectations. It's if you truly expect to get to 1.2 million in revenue, say, then let's make sure we're communicating that and we're meeting those expectations. And then regular feedback. Again, we have regular meetings that we meet with the client. So all feedback back and forth, both from us and to us, and from you to you, we make sure that we're constantly doing that regular feedback. Now, a sample communication plan. So with all our clients, we will set up a standing meeting. These are weekly meetings, and we'll just, when we do the initial onboarding, we'll go through and try to figure out what day and time works best for you each week. Now, normally we don't do Mondays and Fridays. We have yet to actually have a client want to do those, but normally we try to exclude those days of the week just because Mondays you're coming out of the weekend, and Fridays a lot of times people are taking off early. And so, pretty much Tuesday, Thursday, we try to set up a standing meeting. Again, we set up 1 hour. Don't always need 1 hour on there, but we'll set that up. And it's one of those meetings that, we may only meet for 5 minutes one week because there isn't much to go over. Whereas the next week we may go over the full hour. But again, we will be there every single week at that designated time. And if you're not able to, or things happen that you're not able to make it, that's fine. But we just want to make sure we're always on that respective calendar. The other aspect is sometimes you may say, you know what, I don't want to meet every week. I just want to meet once a month. We have had clients that just meet once a month. We'll shoot you emails back and forth and WhatsApp communication, but an actual meeting can sometimes only happen once a month. And then we have some clients that, sometimes they'll need 2 meetings in 1 week type situations. But we want to make sure we have that standing meeting so we're always there, always available. Everybody knows that's when we're going to meet and go over whether it's the past financials, when we're doing the monthly recap report, or we're going over the the sales pipeline, or we're going through cash flow. There's going to be a topic. And each one of our meetings has a set agenda. We set an agenda, and we have specific items that we want to cover on that respective meeting. And again, we have an open door policy. If an urgent question comes up, say you're meeting with a prospective customer or a marketing channel or sales channel, And you need to know, okay, they're asking for an extra 10% discount. Should I pull the trigger on this type situation? So yeah, a lot of times we are available for those kind of urgent questions to say, yeah, go ahead, or wait a minute, hold off, try to get it to 5% versus 10% because of, margin or cash flow. And then we use collaborative tools. WhatsApp tends to be a very popular communication app that we're currently use with our clients. Obviously, email, and then of course shared docs. It's not uncommon that a client will put something into like a Google Drive, Google Sheet, and then share it with us, and then we'll go back and forth on that respective document. Now, we want to just give you a real quick real world case study. And on this instance, one of our clients, they were a medical provider, and they provided these medical services. And when they came to us, they pretty much were kind of just operating the business, but not really knowing where they were going. They were, bringing in the respective patients, billing the insurance, collecting the funds and kind of going through there, but they didn't really have any kind of direction. And so when we met with them, and also they were having cash flow issues as well. And so when we met with them, we first analyzed their financial statements. We got those all tied out. And one of the things we do with our respective clients, and we do it with all our clients, but with them also, is we do what's called a mini audit. So every month on your financial statements, we will actually audit the balance sheet. So in other words, here's the balance that says cash. Okay, that's got to be tied out to a bank statement and the bank rec. Here's the accounts receivable. It's tied out to the AR subsidiary ledger. So one thing for those of you who are unfamiliar with financial statement audits is at its core, a financial statement audit is really just making sure everything on the balance sheet ties to some sort of source documents. That's really the core. Now, there's a whole bunch of other procedures and tests and everything you have to do a financial audit, but for our clients, that's the main starting point for the financials is we'll do a mini audit. So when they first came on, we went through and did a mini audit, and we realized some of their information wasn't correct and had to be moved in different categories or had to be updated. And when we started looking at their respective information, we realized the best way for them to manage their particular company was the per diem rate. So in their particular situation, they got a per diem rate from the insurance company, and it usually was based on the patient days. And we were able to analyze and say, okay, if you're at this level on patient days, let's say it's 6 patient days per day, you're breaking even. So you need to be above the 6 patient days. So let's say 8 is where they're at now, or they've got up to 8. And so because we were able to break that down, we were able to give them the tools to actually manage the company. Now, this isn't necessarily saying here's your total revenue. It's actually a non-financial aspect of looking at the actual patient days. And they were able to look at that, and the COO and CEO were able to analyze that, and they actually had software that literally gave them reports daily as to what their patient days were. And with that information, they were able to say, okay, we're currently averaging, let's say their break even again was 6, they're currently averaging 5. Then they were able to analyze and say, how do we get it up? If we don't get it up, we're going to have a cash flow issue, maybe not this month, but into the next month. And so they were able to use that to analyze their financials and really adjust it. So they were able to go through and look in, with their marketing team and be able to go through that process and determine, okay, let's get that built up. And so they were constantly monitoring that particular KPI. Now, there's other KPIs that were built into this particular company, but that was one of the bigger ones that they were able to put that together. They were able to extend out their cash flow, and they were able to actually ramp up the business. So they were able to understand not only what was going through the business, but how to keep managing it and keep an eye on it. Now, common roadblocks and how we address them. Data access and quality issues. Now, obviously, we need to have access to respective accounting information, and usually that's going to be like a QuickBooks or Xero type program that we can get through online. But the quality issues usually stem from, one, we're going through and we're doing the mini audits, but two, a lot of times when we come across quality issues, it's because the accountant at that your respective organization or their respective organization had not been either trained or nobody ever reviewed their work, so they didn't know, one, they were doing something incorrectly, or two, they needed to be able to go through this process. And one of the things that we noticed, in particular, one of our clients that we started with was the CFO had left, and so then the owner brought us in, and the accountant who was still there, we realized he wasn't properly trained. A very smart individual, but he just wasn't trained. Came right out of college, started working for the company, and as we went through the process, we were actually able to train him to understand this is the process you need to go. For instance, they would only tie out accounts receivable at the end of the year. So they wouldn't actually even look at accounts receivable throughout the year. And this is a manufacturing company that would sell their product, monthly. And so those accounts receivable weren't done. And so we were able to train them, one, that has to be done at a minimum monthly. And when he started going through the process, he started understanding, okay, this is really what I need to do. And so that was one of the things that, when we see quality issues, it's usually because those individuals had never been trained or didn't understand this is actually the way we should be doing, or they should be doing this process. Now, resistance to change and misaligned goals, those tend to kind of mirror or even match one another. And what we've came across is a lot of times when we'll come in, certain individuals are used to doing the this is how we've always done it mentality. And with one of the clients that we had, they had a particular product. It was a labor-intensive product, took up a lot of machine hours, and took a lot of material. And it was one of those products that they only sold to one client, but this was like a legacy client that they'd had forever. And this legacy client happened to be a very difficult client. One of the ones that they complain about not getting their order, but then they take forever to pay their order, and then they want discounts, so on and so forth. And so on that particular instance, we analyzed that product that the customer or our client was building. And we realized, yes, there's a good gross margin on that particular product, but you have better gross margins on these other products that, when you build the product for that customer, it takes up all those resources and you can't build the one with the higher margin. And so we went through and we analyzed and said, no, we really need to stop making this product because we only sell it to one person and it eats up a lot more revenue, net income on these other products. And so, working with management and ownership, kind of made that decision that, let's, phase this product out. And when we would meet with the COO, they had a resistance not to get rid of the product, but, we walked through the process and said, the company's going to make more money building these particular products by not doing this product. You have the time to be able to, and I believe it was like 2 or 3 products for the amount of time and space that it took for that one product. And so a lot of times we work with them, the individuals that may have resistance on there, and just communicate, open, honestly, that there's a reason why we're going through this process. And so we always try to be very proactive in that particular discussions. So what happens after the first 90 days? So again, first 90 days is we're tying out your information, we're building your KPIs, we're determining what your goals are. If you have it, we'll help you build your forecast, your budget, and then also build your forecast. So we've got all that base built in. Now we get into the real strategy part. And one of the big roles of a CFO is to do strategy. And when you build your budget for the current year, so right now it's 2025 and you build your budget for 2025, your budget for 2025 theoretically should be built off of your strategy that you've built for the next, say, 3 to 5 years. And what that means is, if say you're $5 million revenue right now, and you ultimately want to get to $15 million revenue, odds are you probably can't go from 5 million to 15 million in 1 year. So you need to be able to have a plan and a strategy in place to say, okay, I can't do it in 1 year, but I could probably do it in 3 years. So year 1, I want to be at 5 million. Year two, say 7 million, and then year three, we get up to 15 million. And so to get to that point, we need to have an actual strategy in place. And once we have that, then we back down to obviously how much products we need to sell, how much services, how much floor space, inventory, et cetera. We start breaking it down to the actual micro level. And then from there, that will dictate what your budget's going to be for the next year. So again, right now it's 2025. Let's say, to get to that 15 million, we have to have now 7 million in revenue for the next year. We already know what our main goal is for revenue. So now we can start building that respective budget. Because again, when you want to do that big jump, a lot of times there's other factors built in that you need to be ready or have in place before you can even make that jump, such as expand your factory floor, or if you're a service organization, I need to have 3 more techs on staff, or I need 3 more staff attorneys on staff. Whatever the case may be, you need to be able to have that in place so that then you can actually get to that 7 million. Because if you're maxed out capacity at 5 million, odds of getting to that 7 million are slim. So again, after that first 90 days, we're going to start helping you build that strategy. And a lot of times that strategy takes a while. That takes several days of meetings, back and forth, fine tuning. We'll build it out, see that, is this even reasonable, logical? Is it even feasible? Is there even enough raw material in the world to do this? Those type questions, we'll go through that. And once we have that, then we can start backtracking and start building your budgets. And again, this will develop a deeper value beyond just kind of the quick ones that we've gone through. And then obviously, if there's additional add-on services, we can discuss those. Now, our particular company, we're upfront with our pricing. We do not want to charge you for something you don't need. So that's why, if you're curious on how our pricing goes, go to our pricing page, and there's a quick little video. But ultimately, if you don't need it, you don't pay for it. Type situation. We've all had cable TV where you only want to watch 5 channels, but you're paying for 100 channels. You don't want to be paying for those other so many channels that you're not even going to watch. And so that's kind of the mindset here is, if you really don't need it, we're not going to charge you for that, and we want to adjust your fee to what really truly the service is that you truly need. Now, questions. I thank you for those of you who sent in those questions. I apologize for waiting to the end, but I wanted to kind of get through all those slides first. First question here, can you work with our existing software and tools? Yes, we can work with pretty much all the major accounting platforms, such as obviously QuickBooks, Xero, etc. We also work with some of our clients that have software that's kind of a higher end software that isn't the QuickBooks Xero, and we can work with those. It may take us a little bit longer for a learning curve, but usually we can work with those. Case in point, some of our manufacturing clients use ECI, which is kind of the main umbrella for a lot of the manufacturer modules underneath that respective companies, such as M1, Max, et cetera, et cetera. And so we've worked with a lot of those. And once we get that learning curve down, we can definitely work with it. Again, if it's not the standard ones that you see, it may take a little bit, but in the end, it's always important to note that debits and credits are always the same in a software. It's just where's the software putting it and how's the software set up. Can I switch or cancel if my needs change? Absolutely. We are, you should consider us more of a service agreement than a long-term contract. Again, if it gets to the point that, you need to reduce the services because they really don't need it anymore. So let's, for instance, say, as part of the services, we were helping you with the banker relationship. And, let's say the loan is done and your cash flow is to a point that you don't even need to worry about doing the banking anymore. Yeah, we can go ahead and take that service off and adjust the fees accordingly. So yes, we are nimble enough on that. And again, we don't have long-term contracts. We just ask that, if there is a change in service or anything like that, we just have 15 to 30 days just so we can adjust all the respective processes. Who will I work with and how often do we meet? So myself, again, I'm the founder of the company. I'm involved all clients, and especially the first 90 days, I'm heavily involved. I will be involved in all the meetings as well, because I want to make sure that you're getting the service that you need and deserve, and that your companies are moving forward. And again, how often do we meet? Again, we set up standing meetings, weekly standing meetings. Again, it's up to you, the client, whether you want to do those weekly or bi-weekly. That process is really up to you, but we will make sure that we're available for those meetings at that set time every week. And then, of course, we can always be reached by email, WhatsApp type situations. How much does a virtual CFO cost, and what do I get for my investment? So, a virtual CFO cost is really variable on what you need. So it can range from, say, $1,100 a week to $900 a week, or maybe even somewhere in between. And again, with our firm, we adjust the fee based on what you actually need. And so, again, if you go to our pricing page, there's a short little video kind of walks you through the steps that, there are certain aspects within the service that if you don't need it, you don't pay for it. And so we kind of go through, and when we meet with you before you come on, we'll have a set fee. We'll say, okay, we'll meet with you and say, okay, you're gonna need this service, and this service. You don't need these 5 items, and so this is it. There's your set fee. And then for our company, whatever that fee is, let's just say it's $1,000 a week. Whatever that fee is fixed for one continuous year. Now, it's not a long-term contract. It's just that fee is fixed within your service agreement with us. And so we always stress that with our clients is we don't change it once we get to that point. Now, there may be add-on services, or maybe there are services that you don't need anymore that will adjust it, but we'll never do additional billings. That famous thing that you see from attorneys and CPA firms where you get that mysterious little bill that all of a sudden shows up that you didn't know about. We don't do that. So whatever that fee is that we determine on our initial meeting, that is going to be the fixed fee for one continuous year. And then, of course, after 1 year, we'll sit and evaluate how that fee structure is built. And then, of course, I'm sorry, I didn't answer the last part. And what do I do? What do I get from my investment? Well, you're going to get your financials tied out accurately. So it's going to be tied out to respective information, i.e., like I said, the mini audit. Your internal controls will be analyzed by a forensic accountant, and firm controls are put in place. And the important thing to think about on those internal controls, and I stress this several times with some of our newer clients. If somebody steals from you, they're going to steal from your net income, which is your bottom line. Even though they may steal sales, a customer comes into your place of business, pays $1,000, they take the money, they pocket it, they stole it. Even though that was a sale, in reality, they're really stealing from your net income. So, case in point, somebody stole $1,000 from you, and your net percent is 10%. So net is your net income divided by your sales is 10%. You have to earn $1,000 divided by that 10%. So that's $10,000. So you need to bring in another $10,000 in sales just to make up for that $1,000 that was stolen. So part of our service is we analyze your internal controls, because again, like I said in the beginning, it doesn't matter how great your forecast, budgets, cash flow, all that is. If somebody's stealing from you, it's going to completely wreck all that respective information. So we're going to go through your internal controls. We're going to help you build an actual strategy for the next 3, possibly 5 years. We're going to be helping you with not only your budget, but your forecast, and also to be able to react to maybe certain situations that impact your cash flow, such as a tariff. All of a sudden there's a 30% tariff that comes up. How does that impact your margin? How does that impact your cash flow? Can you pass that on to your customer? Again, we're going to be part of that, because in reality, we really are part of your C-suite. We're just on a part-time and reduced cost basis, as opposed to having a full-time CFO sitting there. And then one last question: can you implement faster than 90 days? Yes, we can implement faster in 90 days. That just requires the communication and information from you to come to us at a much faster pace than normal. Again, if we have that and we're getting that information quickly, we can do it faster. Now, there's only so much faster that we can do on that, but yeah, we can definitely do it, implement faster. And if you recall, on the last part of our timeline, it said 7 to 12 weeks. We could get closer to that 8 weeks, if we get all that information in, we get access to the respective accounting data, and there's no issues that we have to go back and fix on the historical stuff. So yeah, we can implement faster than 90 days. So again, thank you for attending. My name's Steve Hovland. I'm the founder of Delegate CFO. I'm a CPA as well as a certified forensic accountant. And if you want to learn more about our company, you can visit us at delegatecfo.com. And again, if you want to know more about our pricing, we have a set pricing page in there as well. So again, I hope that this respective webinar demystified for you what happens once you bring on a virtual CFO, at least on how our particular company does that. And I hope that if you have any questions, again, please feel free to contact me. Again, my email is on that previous slide. Or if you have any questions, you can reach us at steve@delegatecfo.com. I thank you and I hope you have a great day.